Hello, everyone. I'm Sean Garcia, Marketing Manager here at Mazars in the U.S. And on behalf of Safeguard Shore and Mazars, I'd like to thank you for attending our webinar. Today, we'll be presenting cybersecurity and data privacy threats and fiduciary duties confronting the financial services industry, a look at risk mitigation strategies, which will be moderated by Ian Lampel from Lone Street. Ian will be joined by Candace Quinn and Tracy Davis from Safeguard Shore, Peter Shablik from Mazars, and Dan White from NFP. Before we begin, I'd like to review a few housekeeping items. First, we encourage you to ask questions. To do so, please send them to us using the Q&A box on the lower left-hand side of your screen. We will try to answer all of your questions during the webinar, but if a fuller answer is needed or if we run out of time, your question will be answered after the webinar via email. Second, to earn the available 1 CPE credit during today's webinar, you must listen to at least 50 minutes of the presentation and answer at least 3 polling questions. The polling questions are a series of questions meant to confirm that you are actively attending this webinar. Please note that you must be logged in individually to receive credit for today's webinar. If you are attending as a group, only the individual who is logged in will receive credit. If you've completed the requirements, your certificate will be available for download at the end of the webinar. Instructions on how to download your certificate will be displayed on the screen at the end of the presentation, so please stay on the line. To obtain CLE credit, please complete and sign the form that can be downloaded from the green Resources button at the bottom of your screen. A special code will be read out loud during the webinar by one of our speakers, so please pay careful attention. Be sure to record the code on the form and follow the instructions at the bottom of the form. Lastly, you can download a copy of today's presentation from the green Resources button at the bottom of your screen. Here, you will also find our webinar Frequently Asked Questions, a document which offers some basic troubleshooting information and other useful tips. Again, this can be found under the green Resources button at the bottom of your screen. Now, thank you once again for joining, and I'll hand it over to Ian.
Great, thank you, Sean. For those who don't know me, again, my name is Ian Lampel. I'm the co-founder and CEO at Lone Street, a loan syndication platform for community banks and credit unions. We have a very interesting agenda today. First, we'll be covering legal considerations in managing cybersecurity and privacy risk. Next, fiduciary breaches, cybersecurity and data privacy. Third, overview of SOC reports. And fourth, understanding the current cyber insurance marketplace. Our first speaker today will be Tracy. And just to give a bit of background on Tracy, so Tracy is a partner in Safer Shaw's Commercial Litigation Department and Global Privacy and Cybersecurity Group. She is co-chair of the Corporate Governance Subgroup of the firm's ESG Practice Group. She represents various business clients, including financial institutions in breach of fiduciary duty, deceptive practices, discrimination claims, and complex contract disputes, both in and out of court. She is a strategic legal advisor to board of director and C-suite executives on data privacy and cybersecurity, corporate governance, regulatory compliance, and litigation risk mitigation in the areas of fintech, ESG, and artificial intelligence. She has written and lectured extensively on these topics. And Tracy, we look forward to seeing your presentation today.
Thank you so much, Ian, and thank you all for joining us today. I'm thrilled to be here. I'd like to spend my time first focusing on the heightened threats that are commonly known and that are often found on the front page of daily newspapers, as well as those threats that are not so commonly known in the data privacy space. Then I will turn my attention to cover the law and how it addresses liability when regulatory action or litigation takes place, and how proactive and reactive attorneys can be in assisting companies with mitigating these risk exposures. To level set my segment, it's important to recognize that cybersecurity is no longer limited just to securing one's systems and compliance with the vulnerability management protocols and the technical aspects of the law. Securing data and data management must be viewed as multifaceted and through a broader lens where overlap between technical solutions to cyber threats are viewed in the larger context of good information governance and data privacy, data usage best practices. Types of threats. We all must remain vigilant in knowing what kinds of threats exist and that companies often have to confront. There's the typical wire fraud where emails are fabricated to trick the recipient into believing that they know the sender, usually with the goal of having the sender wire money or provide access to an account. Ransomware, which is frequently on the front page of the paper, where through use of malware, corporation systems or its data are held hostage in exchange for payment. Phishing, where access to systems is gained in order to exfiltrate corporate information. In addition to being aware of the basic threats that exist, knowing the type of threat actors is also a part of good cyber education. Hackers often engage in corporate espionage or, as I mentioned before, ransomware attacks. Disgruntled employees can also be the culprit where they have authorized access to corporate information but use that access for ill-gotten purposes. Also, malicious hackers sometimes may be just doing it for thrills. Sometimes they're motivated by those types of activities. But most critically important and commonly now of major concern is third-party vendors who are given access to corporate information and whose systems are penetrated by hackers who then access the corporation's data and or systems. In identifying these potential risks, it's important to recognize that corporations themselves have access to personal identifiable information, information of not only their employees, but that of their customers and the users of their services. The collection, storage, use, sharing, and processing of what's called PII is generally the subject of data privacy laws. But the scope of what is PII, personally identifiable information, is now not always limited to just the person's name, address, phone number, social security number, your IP address, your geolocation, spending patterns, your health information, keystrokes on a computer, all permit profiles to be created. Usage of this type of information, you should note, is largely unregulated. So that means regulatory compliance may not be enough to protect corporations from the reputational harm, financial loss, and operational challenges that may come from its use of customer data. Why is compliance not enough? Compliance is generally not enough because the current regulatory framework is a patchwork of regulations, which tends to be industry-specific and principle-based rather than prescriptively mandating specific corporate behavior. For instance, the FTC, which governs consumer-facing producers of goods and services, in its regulatory enforcement actions assess whether consumer policies and practices violate their broad prescription against unfair or deceptive business practices. So within the context of cybersecurity and data privacy, if a company advertises that in using its services, consumers' data will be kept safe and secure, the FTC could potentially find and have a violation of this general prescriptive standard based upon known system failures and their misrepresentation of the level of security that in fact exists. The SEC, just one other area that is broadly prescribed is the SEC looks to see whether or not corporate practices are accurately set forth in disclosure statements, for instance, SOC reports, to see whether or not the information set forth in there is the kind of information that a reasonable investor making an investment decision would reasonably want to know. So, for instance, in the financial services space, if you look at corporate disclosures, generally it is disclosed that they are the subject of cyber threats and that their risk mitigation measures are insufficient to completely ward off any breach. Finally, I think it's important for everyone to recognize that when it comes to data privacy litigation, usually disclosure and consent approach are the issues that are the focus, and the court and the litigants are looking to see and determine whether or not adequate notice was given of the particular kind of data usage, and and whether or not the consent was provided for the particular usage that's the subject of the lawsuit. Regulators have created frameworks that establish basic industry standards. For instance, the New York Department of Financial Services was one of the first to make it mandatory that financial institutions provide design systems that ensure the safety of the institution's systems as well as the security of their customers' information. What's noteworthy when looking at regulatory frameworks, best practices and procedures, industry best practices and procedures, is that those basic standards that are adopted industry-wide can be effectively read into the law such that corporations would be held responsible for what their competitors are in fact doing as well. So the question is, if your competitor is doing annual vulnerability assessments, then when there is a breach, the regulators in enforcement actions will utilize and look at that standard to measure your corporate response. In addition to the federal patchwork, there are also state statutes that have delved into the privacy area, again, where they are regulating and establishing laws on the access and to consumer data, as well as giving consumers the right to greater right to manage their own data. The important thing to note is that currently there is no federal privacy law. There is no state statute which deals with use of artificial intelligence or algorithms. So that area is viewed as a gray area, where we'll talk a little bit later about how there is a need to fill the gap there where there is no regulation guiding corporate behavior. I included the slide regarding COVID-19 and the recently adopted guidances that have been issued by the Department of Financial Services and others, because with COVID, there's become an increase in risks and threats as a result of many more uncontrolled devices being used in uncontrolled environments, thus allowing greater access, potential access to corporate systems. So with this patchwork environment that currently exists, I mentioned that there are unregulated gray areas, and corporations in this space have been forced to design their own frameworks to address the cybersecurity and data privacy risks that exist. Many rely, again, as I said, on industry standards, but it is important to note that regulators have begun holding boards responsible in the event of a breach. So the question is, what is the scope of the board's responsibility and how do they manage it? They do so by ensuring that they become knowledgeable and aware of what's going on within their organizations as far as cybersecurity and data privacy risks. Board duties, as many of you are aware, board members along with officers have an obligation to act with care, with loyalty, and in good faith. That obligation is owed to the corporation and its shareholders. Generally, there is no technical expertise that's required by board members to carry out their responsibilities when it comes to assessing cyber risks, data privacy risks, but they often and are generally advised to make certain that they avail themselves of outside experts that they believe have the expertise to assist them in understanding of the risks and to taking appropriate action. Boards must also see to it that there are plans in place, policies and procedures in place, and that there are internal controls that are in place to ensure that in the event there is a gap, there is a breach, that responsive action be taken. Among the experts that boards are often sought reliance as far as expertise, cybersecurity attorneys, privacy attorneys can be very helpful in making certain that the appropriate risk assessments are completed, that third-party vendor protocols are put into place, contract provisions when dealing with third-party vendors are sufficient to withstand liability in the event of a breach. Training, adequate training occurs on a regular and systematic basis, and communication, effective communication of risks makes its way through the corporate structure. All of these areas, along with, in the event of a breach, taking the appropriate response, complying with the required notices, all of these things are also areas where cyber attorneys can be effective and of assistance. Key takeaways: it's important to be proactive, making certain that you educate yourself in exactly what's happening in the cyber, as particularly the privacy space, knowing that the expertise is out there and making certain to stay current. With that, I'm going to turn it back over to Ian, and thank you all for your time.
Great, thank you, Tracy. Actually, I'm going to turn it over to Sean to do the polling question.
Yes, thank you, Ian. So the first polling question of the webinar is up on your screen, and it reads, is compliance with cybersecurity and data privacy laws and regulations enough to protect a company against the risk of liability in the event of a data breach? Yes or no? Please make your selection now and be sure to click the submit button to get credit for your answer. Okay, we'll give it a couple more seconds. Be sure to click submit. Okay, let's take a look at the results. 90.5% of the audience said no.
Well, it sounds like the audience is well underway to making certain that they understand the new legal environment and landscape that they're in. So it's a good answer because the laws aren't simply enough to make certain.
Great, Tracy. Really appreciate the information today. We have a lot of different questions. I think we only have time for one, so I'm sure Tracy will follow up with those others after the panel today. But the one question I will ask is, what future trends do you envision happening in the legal assessment of liability in this space?
I think what you will find in the privacy space, more scrutiny is going to be given to privacy policy statements and whether their readability and whether or not they are vague or specific enough to really put the consumer on notice such that it protects against liability in the event of a class action privacy litigation. That's just one of many. I think you're going to also see a lot more talk about trust models and frameworks rather than just relying on compliance with the law. So those are just two, but that's what I see in the not so distant future.
Great. Thank you so much, Tracy. Sean, should we progress to section 2? Perfect. So this one will be fiduciary breaches, cybersecurity, and data privacy. And Candace will be our speaker, and I'll just give a brief bio. Candace has extensive tax and legal experience in employee benefits and executive compensation, representing for-profit and not-for-profit entities. Her practice focuses on domestic and cross-border regulatory and operational qualified and non-qualified plan compliance, executive compensation plan design, fiduciary standards, Department of Labor guidance on safeguarding retirement plan assets from cybersecurity threats, best practice corporate governance, internal controls, as well as the Internal Revenue Code and ERISA. I will turn it over to you, Candace.
Thank you very much, Ian and Ms. Ars, for this opportunity to present today, and for all of you for joining us for this discussion on fiduciary breach, cybersecurity, and data privacy. In the U.S., retirement savings and defined benefit plans with 34 million participants in private pensions and defined contribution plans with 106 million participants have an estimated $9.3 trillion in assets as determined by the Department of Labor. Due to the significant amount of funds in these accounts, theft of participant retirement assets and confidential private information, including financial data, is a significant target for identity theft and fraud transactions. Now, there's been an increase in class action lawsuits involving the Employee Retirement Income Security Act, or ERISA, which is the federal statute governing private retirement plans. Now, some of these lawsuits have included allegations of fiduciary breach for cross-selling confidential participant data. And ERISA is silent on data protection in the form of electronic records. There is no comprehensive federal regulatory provision governing cybersecurity for retirement plans in the U.S. And recent ERISA litigation has included allegations of record keepers cross-marketing that data without participants' knowledge or approval. And this can include accessing the plan participants' contact information, financial data, investment preferences, age, and date of retirement. Now, ERISA does not specifically address if participant data is a plan asset protected under ERISA. Although ERISA does not outline specific rules for protecting data, the Department of Labor, which is the enforcement agency for ERISA plans, has recognized the risks related to electronic communication of plan information and directed plan administrators to take appropriate action to protect confidential data. Now, not only did the Department of Labor recognize the risks of electronic communication of data, on April 14, 2021, the Department of Labor announced guidance on safeguarding retirement plan assets from cybersecurity theft. The guidance for plan sponsors, plan fiduciaries, record keepers, and plan participants consisted of 3 documents. First, tips for hiring a service provider, and it contains questions to ask the provider before trusting them with plan assets and monitor their activities, including conducting audits by an independent third party of the cybersecurity policies and compliance. And the guidance includes information to be sure that of the provider's use, sharing of information, and confidentiality. And the guidance also provided a contract with the service provider should spell out the service provider's obligation to keep the private information private and prevent the use or disclosure of confidential information without written permission, and to meet strong standard of care to protect confidential information against unauthorized access, loss, disclosure, modification, or misuse. Now, providers should validate its security practices, and including its track record and any security instance and any litigation. And you should check the provider's cybersecurity insurance. The second Department of Labor document was the Cybersecurity Program Best Practices. To avoid being targeted by cybercriminals, a company should conduct risk assessments by an independent third party to test the security controls. Now, Peter will discuss more on risk assessment and SOC 2 reports in his session, which follows this presentation. Now, a company must have a cybersecurity program, and a company should have strong controls and conduct reviews. The third document the DOL provided was online security tips. To reduce the risk of fraud and prevent loss of retirement assets, it recommended that participants be provided with training for online security preventive measures. However, remember, fiduciaries still have a duty to keep the plan safe, and ERISA provides that a plan fiduciary who breaches his or her fiduciary duties is personally liable for any losses to the plan resulting from his or her breach. So it is important to understand what the company's cybersecurity insurance and fiduciary insurance covers. Now, individuals have trillions of dollars in these retirement plans, as well as confidential, sensitive personal information, which is a target for cyber criminals. And more data is stored online, and transactions are taking place online, which creates opportunity for cyber criminals. It is important for a sound security program to identify and assess internal and external cybersecurity risks that may threaten the confidentiality and integrity of stored non-public information. So what does ERISA protect? Well, monetary assets of a participant are plan assets, and fiduciaries must meet a prudent standard and protect that from theft and cybersecurity breaches. Now, whether a failure to protect retirement plan-related financial data is a breach can depend on whether the financial data is considered a plan asset. It's the DOL's position that assets of a plan are generally to be identified on the basis of ordinary notions of property rights under non-ERISA law, and that is based on a DOL advisory opinion from 1992. There are several different tests that could be applied to determine whether a participant's data has value and if these assets should be considered plan assets. Due to the focus of the value of personal data in our current society, a recommended approach is to take careful steps to protect it. Yet ERISA class action lawsuits continue, including with allegations of fiduciary breach with failing to safeguard that confidential information of the participant. So what has been the result of the litigation? Well, in one class action settlement, the sponsor agreed to prohibit the record keeper from cross-selling proprietary services and using participant data only if the participant requested and allowed it. In another case, it was determined that the personal information of the participant is not an ERISA plan asset, as the personal information of the plan participant is not property the plan could sell or lease. Now, this is based on DOL notions of property rights. But ERISA class actions have continued with a focus on excessive fees and including allegations of record keepers' use of this data to aggressively market financial products and services. And the allegations against the record keeper are they're selling the participant data to replace lost or reduced revenue from retirement plan fees. In a recent 2021 ERISA class action alleging excessive 401k fees, including allegations that the record keeper breached its fiduciary duties to plan participants by sharing that participant data with an affiliate to benefit the record keeper to market its retail products, but not to the exclusive purpose of providing benefits to the participant and beneficiaries. The court looked at the text of ERISA, and the court found that plan assets include investment assets, not data. And they cited to other courts' decisions that based on notions of property rights, but acknowledged that data of participant has some value. So ERISA litigation and cybersecurity continues. So what can fiduciaries do? Well, there are no federal statutes specifically addressing retirement plan cybersecurity obligations, and ERISA, which was enacted in 1974, is silent on data protection in the form of electronic records. But cybersecurity and data privacy is not just an ERISA issue. Majority of states have some statutes governing privacy and cybersecurity. And fiduciaries have a strict fiduciary duty of prudence and loyalty. And with ERISA litigation and cyber breaches continuing, then what preventive measures can the fiduciary take? Well, risk management strategies include having, for a sound cybersecurity program, have a cybersecurity and data privacy program to safeguard the confidential data, and identify and assess internal and external cybersecurity risk and threats to that private information, and conduct risk assessments and cybersecurity reviews, and conduct audits and internal control assessments, and select service providers with strong cybersecurity programs, review the contract with the service provider, and review the cyber insurance. And Dan will discuss more about cyber insurance following Peter's session. Now, with regard to fiduciary steps to protect participant data and safeguard electronic access, be educated on the law and negotiate cybersecurity protection in that service provider's contract to protect participant data and account balances. Read the contract. Make sure it contains privacy and data protection. Make sure there is even a contract and it's not just marketing material. ERISA can provide guidance with regard to RFPs, and fiduciaries should monitor the service provider to protect the participant data and determine if the service provider is cross-marketing the data, limit record keepers' use of participant data without their knowledge. And fiduciaries need to understand the risk associated with transmitting data to service providers and be mindful of their ERISA fiduciary duties. Okay, I see we have another polling question. I'll turn it over to you, Sean.
Thank you, Candace. So the second polling question of the webinar is up on your screen, and it reads, do you review internal controls to address data privacy and cybersecurity to prevent breaches? Yes or no? Please make your selection now and be sure to click the submit button to get credit for your answer. I will give a few more seconds. Be sure to click submit. Two more seconds. Okay, let's take a look at the results. 88.4% of the audience said yes, Candace.
Okay. Well, that's excellent to see. Significant number that are conducting internal reviews, because it is very important to review your cybersecurity policies and compliance with those policies. And it's not just a one-time effort. It's something that is a continual focus. So I'm glad to see people are aware of this need. And with that, I'll turn it back to Ian.
Sure, great, thank you. And again, we have a number of wonderful questions from the audience, and we'll follow up with the appropriate questions afterwards, but I think we only have time for one, so I'll ask this one. What can a plan sponsor do if their service provider's agreements allow the third-party plan administrator to share the participant's confidential information, such as retirement date and financial assets with an affiliate, in order to offer retail retirement investment products without the participant's knowledge or approval?
Thank you, Ian. That's a really important question. Is if the plan sponsor has already signed with an agreement with a third-party provider that allows the record keeper to share that data, then the question is going to become that a plan sponsor who now is aware of the concerns that participants may have that their private and confidential information is being disclosed and in many cases cross-sold to an affiliate to benefit the record keeper and certainly not the participant, then this is something that the plan sponsor should seek to change with the record keeper. Now, because they have an existing contract, that may not be necessarily easy to have them do, but an alternative is when the record keeper's agreement is going to be up for renewal. The plan sponsor can consider conducting an RFP for record keepers and make cybersecurity and data privacy a key requirement of that request for a new record keeper and prohibit record keepers from sharing participants' sensitive confidential data without the participant's approval. And these steps need to be thought of in advance of signing with a record keeper. So it's something that needs to be reviewed now. People need to look at the policies that they have in place because they may not even be aware that this data is being shared because it hasn't been raised. So thank you.
No, that's a great answer. Thank you so much for that. So now, overview of SOC reports. I'll give a brief bio. So Peter, who's going to be our panelist here, has more than 30 years of experience delivering auditing, information technology, and advisory services to the banking industry. He has assisted banks in arranging mergers and acquisitions, remediating regulatory criticisms, complying with internal and information technology audits, and achieving high performance through process reengineering and implementing information technology solutions. He is recognized nationwide as an expert in information security, privacy, and penetration test vulnerability assessments and industry trends. So Peter, we're very interested in seeing your presentation today.
Thank you, Ian, and thank you, Tracy and Candace. I think the information you provided was very valuable on what can go wrong and the risks we have in today's world. The SOC report section, I'd like to talk about what can an organization do to demonstrate they have controls in place. What can they tell their stakeholders, their business partners, customers, user organizations, or what have you, that they have controls to protect the integrity and accuracy of their data. So the SOC report, SOC stands for System and Organization Controls, and it's an AICPA standard, American Institute of Certified Public Accountants. It's probably I think it's fair to say it's the strongest standard out there right now in terms of how to attest that you have controls in place. There really is no SOC, no cyber per se standard, but the SOC standard includes 5 areas: confidentiality, privacy, process integrity, availability, and security. And by addressing those five areas or criteria, you can really demonstrate to the world you have a strong program in place. Nothing's foolproof, but it's a measurement that gives comfort to the organizations. Now, why is SOC reports so important? Just going to go to the next slide. As Ian said, 30 years. In the early 90s, it wasn't a SOC report. The SAS 70 standard came out. And back before 92, most functions were done internally by companies. But in the late 80s, early 90s, processes started to be outsourced to third parties. And in the early 90s, really, the payroll was the number one process. For those of you that were ever involved in payroll, you know how difficult it is to run a payroll internally. have to keep on track of the laws and compliance. You have to have adequate funds transfer. You have to have segregation of duties. And then there's penalties and fines if you don't comply with payroll rules. So in the early 90s, organizations saw they could outsource payroll. For an organization, and ADP was largely the primary one at the time. They could reduce cost, they could reduce risk, they could access to better solutions, better technology, all through an outsourced relationship. But what the world realizes, okay, well, now the risk is not when you're doing an audit, and the SAS 70 was related audits, financial audits. It's not just about the controls about the company, it's about the controls of the service providers. So in the early 90s, the AICPA came out with the SAS 70 standard for financial reporting, controls around a financial organization. So the starting point was, say, payroll. If the payroll provider had 1,000 customers, do you want 1,000 user organizations auditing the organization? No. So what happens is the ERISA came out with the SAS 70 standard for an auditor, a service auditor, to do a review of controls of a provider, and then the user auditors can rely upon this. So it was really initially an auditor-to-auditor communication for financial reporting. The concept of SOC 2 didn't exist back then, but from the ensuing several years from 92, and I should say in 92, before 92, the concept of internal controls was not very strong. I remember before 92, there was government controls with some definitions in the 40s, I think, but really internal controls really didn't kick in until 92. And that also in that same year, for those of you that were involved in that, or the COSO standard, which is a basic framework for for control frameworks. The Treasury Commission came up with their pyramid structure of risk assessment, control environment, control attributes, monitoring, and information and communication. And the banking industry came out with the Federal Deposit Insurance Act, the Fiduciary Act, which at the time any bank over $500 million in assets had to have a control attestation. So that really started in the 70s, from the early 90s, 70. But from 92 to, let's say, 2009, it was just the SAS 70. And what had happened in that time period, many companies that didn't have a financial reporting relationship, where it wasn't a SAS 70 didn't make sense, wanted some type of assurance. So what happened in 2010, the EICPA came out with SSA 16, which included SOC 2, which we'll talk about primarily here, is really internal controls not related to financial processing, but related to internal controls, as I said before, about privacy, security, availability, processing, integrity, and confidentiality. So now you could do an opinion on that. And why is that important? Well, as organizations from the early 90s till today have outsourced more and more, you think about all the things that are outsourced. We're outsourcing Microsoft Office 365, printing, payroll, benefits, expense processing, just a myriad of things. You really you want to make sure your customer and your data is protected. And how do you get that assurance? One of the strongest methods is the SOC report. So really it was in 2010, again, the SOC 2 came out, and again, SOC 2 is those 5 criteria. Next slide here. Again, what is a SOC report? It's a third-party audit report. I won't go too far into this, but it's either financial reporting or it's internal controls related to data integrity and quality. And it's designed to really provide 4 opinions, rather. Are your controls designed adequately? Are they fairly representative? Placed in operation? And in the case of what's called a Type 2 exam, are they operating effectively over a period of time? So it really is a fairly rigorous standard. And again, it gives the users a high level of confidence that controls are placed into operation. Again, the SOC 1 and SOC 2. SOC 1 is, again, financial reporting. It's an extension of your information system, your financial information system. It's got control objectives that can be defined to suit the business. And it's really appropriate if you're hosting financial information that could affect your client's financial reporting. The payroll feeds into that. I remember it was about 15 years ago, I was approached by WebEx. We want a SAS 70. And I said, well, for your customers, I said, you can't have a SAS 70, which was equivalent of a SOC 1 at the time, because you're not processing financial information. You're sharing conference sessions. So SOC 2, again, in that kind of situation is much more appropriate, because you're hosting or processing other information where you're concerned about confidentiality, privacy, and so forth. There are concerns about how you're handling data in a secure way. And it doesn't doesn't just have to be, it could be any provider, any service or vendor that processes data. You give them confidential data. How do you know that data is adequately controlled and protected? Or vice versa. It could be your customers are asking for this. We, as a firm, we have a SOC 2 Type 2 report because our clients, we don't process financial information. We don't do reports for clients, but we do audits, so we have access to information. So it's important that they have that confidence. It's very important across a lot of industries that they have that confidence. The SOC 2, again, reports can focus on security, availability, process integrity, and confidentiality, and privacy, and aren't just related to financial reporting. Just a little bit of a deep dive in those 5 areas. Security. The SOC 2 standard is a very prescribed standard by the AICPA. It's got what's called trust services criteria that you have to conform with. When you do a SOC 2, you have to comply with at least the security, or at least cover the security criteria. And that has 37 trust criteria that have to be met. And that's we have to define one or more control for each trust services criteria. Availability, which deals with restoration and redundant systems and be able to recover after a disaster, has 3 trust services criteria. Process integrity, which can be very broad, but the completeness and accuracy of data being processed. That's got 5. Confidentiality. And that's really, when we say confidentiality, it's more business to business. Things like patents and intellectual property and customer lists, things like that. That's confidential, as opposed to privacy, which is personal information. And as Tracy said earlier, it's becoming broader and broader what a definition of personal information is. And again, with emerging state regulations, which we don't. I know of several of them now. I'm sure there's more on the books. New York, Massachusetts. Other states have their own private. California have their own privacy regulations, and that's continuing to expand. But again, this is a fairly broad area, and there's some flexibility, but you do have to meet the minimum criteria in order to have a SOC 2 report issued. So why do we do this? Address risks. The process of doing a SOC 2 can be very healthy for an organization. It really help address risks, a broad range of risks regarding privacy, integrity, confidentiality, and so forth. Reduce compliance costs. Well, the example I gave earlier about ADP, we've had a couple of clients that said, listen, we've got a dozen clients that are coming in with detailed checklists, and we have to respond to all these. We have a SOC 2 report done, and we hopefully reduce, if not totally eliminate those checklists? And then the answer is yes. And we do that. When we respond to RFPs, so here's our SOC. I think this answers most of the questions on your checklist. It reduces the cost quite a bit for complying with customer or business partner demands. You're providing better service. You're giving a lot more information, a lot more guidance to your customers. There's a section called Complementary User Entity Control Considerations, which helps quite a bit in terms of giving guidance. Increases trust. You're meeting contract and stakeholder expectations, and finally, you're gaining a competitive advantage in many industry segments and many technology areas. We've seen that it gives a competitive advantage. With that, I'm going to hand it over to Sean, who's going to go over the question.
Thank you, Peter. So the third polling question of the webinar is up on your screen, and it reads, please select the correct answer regarding SOC reports. SOC 2 reports support external auditor reliance upon controls for a financial audit. SOC 2 reports focus on the protection of information and are often provided to user organizations as part of the vendor due diligence process. SOC 1 reports support the security, confidentiality, privacy, availability, and processing integrity. SOC reports provide evidence that cyber breaches will be prevented, or all of the above. Please make your selection now and be sure to click the Submit button to get credit for your answer. Okay, we're going to give it just a few more seconds. Be sure to click submit. Okay, we're going to take a look at the results. Okay, so 59.3% of the audience said all of the above, Peter.
Oh, the right answer was the second one. A SOC report does not provide evidence that cyber breaches will be prevented. I don't think nobody answered that one, right? So that's not correct. So all above wouldn't unfortunately work. SOC 2 reports support security, confidentiality, privacy, availability, and processing, not SOC 1 reports. And SOC 1 reports support external auditor, not SOC 2. So it's really SOC 2 reports focus on the production of information and are often provided to user organizations as part of the vendor due diligence process. So good try.
Tough question, Peter.
I know, I was tough. Sorry about that, guys.
But no, great presentation, and we have some great questions here. I think we are running short on time, so I'll only ask one. There are many organizations that provide security assessments and reports along with their own private certification. What differentiates a SOC 2 examination report from these other solutions?
Well, it's really it's most known in the industry. It's backed by the AICPA. It's a very broad standard. Like, there are some niche industries and some niche players, but they don't have a broad independence appeal of the SOC 2 report. It tends to be the leading authoritative statement across these areas.
Great, thank you. So now on to understanding the current cyber insurance marketplace. Dan White will be speaking from NFP Insurance and has worked as a generalist in the insurance industry for 20 years and now specializes with his team at NFP to provide best-in-class coverage and pricing for companies worldwide. Dan, I'll turn it over to you.
Thanks, Ian. Appreciate the intro. Thanks, everybody, for joining today. I guess they normally say you save the best for last, but today I'll be the quickest for you. Cyber attacks seem to be, an everyday norm now. Going back 10 years ago, we hardly heard of any such things in the news. Today, it doesn't matter if it's, a large-scale pipeline attack, a water supply attack in Florida, to a small business sending out a miscellaneous $88,000 to somebody on a fake invoice that they've received. These cyber attacks will continue and definitely are here to stay in today's world that we live in. What do these cyber attacks look like for the companies that we have here that are being faced with the hacks? It's kind of going along with what Tracy said. We have ransomware, email cloud systems, mobile devices of employees, social media platforms, employee HIPAA information, and other areas that need plans in place to protect our companies from these hackers. These attackers are brought in through business partners, as was mentioned previously by all the folks that were prior to me with Tracy's presentation and Peter's also, and Candace's. These companies' data that who have our data and the measures of security that they have, we need to make sure that they are limited and tested to a level that will be in accordance to the industry standards. These standards would normally be founded by going through the SOC that Peter had mentioned earlier. As we have potential gaps of security brought in by employees who have negligent use, store or share data in an unsafe manner, allowing for hackers to easily penetrate. As many of you know, a hack can cause serious business interruption to the company, shutting down systems, bringing businesses to a complete halt, and costing companies large retention amounts and increased costs due to improper cyber insurance program. Not to deviate from the presentation, but one recommendation I strongly suggest is building a culture among your employee population to have them alert your tech departments immediately if they feel something doesn't seem right or they are suspicious of a breach that might have occurred. Time is definitely money, and caught early, the severity of the claim should be dramatically reduced. Sorry, skip the skip them there for you. The next slide is just a quick explanation of how cyber ransom claims are being paid out. The frequency is up on the actual claims. The payments are going down. It seems that the hackers are striking more regularly but requiring less payment. The industries most targeted are the healthcare, public sector, and professional services. This slide, the next slide, shows cyber claims are not just that one-time payout, but a continuous financial impact that the companies are facing due to possible lost business, whether that stems from customers' confidence in your company's data security practices, public relations, or reputation inability to complete a contract, interruption of supply chain or for many other reasons. Because of the severity of these business interruption claims, the marketplace is experiencing large cyber insurance premium increases. This is getting into the portion of where I can give you the cyber outlook and how the marketplace is doing in regards to coverages, pricing, and regards to what the carriers are seeing in regards to claims. During the first 2 quarters of 2021, we have seen pricing increases of 100 to 150%. This slide that I'm showing you is a little bit old, and it says about 50% in Q2, and we're seeing dramatic increases in Q3. The retentions, which are the deductibles to these policies, are being increased to 50, 100, and 250,000. Not only with the cost increase and the retentions being increased, we have seen insurance carriers reducing total limits of insurance downward and requiring customers to get additional limits from other carriers to reduce the carrier's overall risk. And what I mean by saying that is that we're seeing carriers go from 10 million limits to 5 million and even down to the 2 million limit, especially on third-party coverage. They don't want to be responsible for the other folks that you're utilizing as vendors to possibly have claims there. Also in the marketplace, there have been many insurance carriers sublimiting certain coverages. The carriers used to allow these coverages to be included in total policy limit. So if you had $1 million limit before, they're normally sublimiting them down to 100, 250. These coverages are extremely important and sometimes being reduced down to as little as what I mentioned before, 100 to 250,000, whereas compared they used to be at the 1 million, 5 million, and 10 million limits on previous policies. Also, in the marketplace, you used to see a possibility of a 3-year policy, whereas now they will definitely only do a 1 year, and the scrutiny and the underwriting is getting much more strenuous on the companies that are having to fill out applications to even obtain these policies. To wrap up, I've included kind of a summary of the cyber-related events just happening in 2021 for your review later. But I did want to mention one in particular claim that stood out to me, and that was the Florida water system attack, which is actually on the next slide. We all think of cyber attacks as financial personal information being exploited, but this attack really struck me as a hacker maliciously trying to hurt people physically by poisoning a water supply in Florida. We hope these are rare, but we continue to see more and more of these harmful attacks. And in this digital world we live in, we hope that we can utilize the tools to protect our data and system to the best we can prevent these hackers from causing financial, personal, and bodily injury to the general population. In ending, the cyber insurance marketplace is adding additional coverages that all cyber insurance decision makers should be aware of. I shared these on this last slide. These are new coverages, and not every insurance carrier will be offering them, but ones you should definitely be consulting with your insurance broker about. The 3 that I would like to highlight and recommend purchasing are definitely the consequential reputational harm coverage, social engineering, financial, fraud, and invoice manipulation. In regards to the social engineering and the invoice manipulation, these coverages have had a gap between cyber and crime policies, which created a gray area in the time of claim. These coverages will help close that gap and allow for coverages to be provided on your cyber policy. Now back to Sean for one of our polling questions.
Thank you. So the 4th polling question of the webinar is up on your screen, and it reads, Does your firm have a cyber response plan in place if breached? Yes, no, I don't know. Please make your selection now and be sure to click the Submit button to get credit for your answer. And we're just going to give it a couple more seconds, so be sure to click Submit. Okay, let's take a look at the results. So 80.3% of the audience said yes.
Yeah, that's excellent. And those that don't have one definitely should try to work with your broker in regards to putting that in place.
Great, Dan. I know we're short on time, so I'll only ask one of the questions from the audience. What would you recommend to reduce our company's risk by potential breaches from our own employees' personal activities?
Two forms of authentication right now is the number one thing that they're saying would reduce that risk. We're seeing that the carriers are actually requiring this now, and you might not even be able to obtain a cybersecurity policy if you don't have that in place. Hope that helps.
Okay. Sean, should I move forward now with the CLE code?
Yes, please.
Okay, for those who need the CLE code, it is SS8903. Again, that is SS8903. And with that, I'll hand it back to you, Sean.
Great. Thank you so much, Ian. We hope everyone enjoyed today's webinar. Thank you once again to all of our speakers. If you've completed the CPE requirements, your certificate is now available for download. You'll see the instructions on the screen now. If you're a Mazars employee, no need to download the certificate. If you need CLE credit, don't forget to download the form from the green resources button at the bottom of your screen and follow the instructions. We also encourage you to tell us what you thought about today's webinar by completing our feedback form, the link to which you will see on the screen shortly. Please take a minute and click that link once we conclude here. Feel free to reach out to any of today's presenters or myself with any further questions. Thank you once again for joining us, and enjoy the rest of your day. Stay well, everyone.